$7.4 billion. Yeah, you heard me right. That's the staggering amount of money in overlooked tax deductions that freelancers and independent workers miss out on every single year. Just let that number sink in for a second. If you're self-employed, part of that $7.4 billion is very likely yours. It's just sitting right there on the table waiting to go to the IRS instead of staying in your bank account where it belongs. Well, today, we're going to change that.
Welcome to The Explainer. I'm so glad you're here, because today we are untangling the massive opportunities and the hidden risks for self-employed folks in 2026. The tax code has seen some sweeping updates recently. Whether you're a gig worker, a freelancer, or a thriving solopreneur, these new rules can either completely supercharge your savings, or they can land you in some serious hot water if you aren't prepared.
All right, here's our roadmap for today. We'll quickly cover the 2026 tax landscape, maximizing your solopreneur deductions, and supercharging your retirement. Then we'll pivot to navigating the audit trap, and finally, setting up bulletproof record keeping. Let's dive right in.
Part 1. The 2026 tax landscape.
So the newly enacted One Big Beautiful Bill Act, which you're going to hear referred to as OBBBA, has brought some huge legislative shifts. The standard deduction bumped up to $15,750 for single filers. The child tax credit increases to $2,200. For seniors, there's a brand new additional $6,000 deduction. The bill also establishes government-funded Trump savings accounts, dropping $1,000 for eligible children born between 2025 and 2028. Oh, and on the flip side, keep in mind that the electric vehicle credit completely ends in September 2025. Those are the baseline rules of the game right now.
Now, two of the most buzzed about provisions are the no tax on tips and no tax on overtime rules. If you earn tips, you can now deduct up to $25,000 of that income. Working overtime, you're looking at a deduction of up to $12,500. But heads up, there is a catch here. Both of these incredible deductions start to phase out if your modified adjusted gross income, which is basically your total income after certain deductions, creeps over $150,000 for single filers.
Moving on to Part 2. Maximizing solopreneur deductions. 50 grand. Seriously, if you run your own business, OBBA essentially handed you a brand new toolkit to drastically reduce your taxable income. And if you're just starting a business in 2026, this is a massive leap. Under the new laws, the startup cost deduction has skyrocketed to $50,000. Meaning, if you're sinking cash into getting your new venture off the ground, you can write off up to $50,000 right out of the gate. This is an absolute game changer for new solopreneurs. And for those of you already operating, let's talk about the road. 72.5 cents. That is a record high standard mileage rate for 2026. Because costs are rising, the IRS is actually giving you more back for every single mile you drive for business. Tracking every trip, down to the mile, is quite literally more lucrative now than it has ever been in history. Please do not leave this money on the dashboard. Now, if your business requires heavy equipment, computers, or vehicles, you're going to want to hear this. Section 179 now lets you write off an astonishing $2.56 million in equipment. On top of that, OBBBA brought back 100% bonus depreciation. That means you can buy a qualifying asset, and boom, you immediately deduct its entire cost from your 2026 income instead of spreading it out over several years. It's an amazing way to severely drop your tax burden.
Okay, Part 3. Supercharging your retirement.
So you're keeping all this extra income. What should you do with it? Let's look at how the 401k limits have expanded to shelter that money. As an employee, your base limit gets a sweet $1,000 bump up to $24,500. The total combined limit rises to $72,000. If you're 50 or older, your catch-up amount jumps to $8,000. And a quick note, that super catch-up for folks aged 60 to 63 holds steady at a massive $11,250. But hold on a second, there is a vital catch here for high earners. Starting in 2026, the Roth catch-up rule is in full effect. If you pulled in over $150,000 the year before, you absolutely must make those 401k catch-up contributions as after-tax Roth contributions. You just can't use those catch-up dollars to lower your current year's taxable income anymore. It's a pretty huge pivot in tax strategy. But here is where the magic happens for the self-employed. Remember that $72,000 total limit we just talked about? Well, if you have a solo 401k, you're playing the role of both the employee and the employer. So you can max out your $24,500 employee contribution and then just keep making employer profit-sharing contributions to yourself until you hit that massive $72,000 ceiling. Honestly, it's one of the absolute greatest tax shelters available today.
All right, part 4, navigating the audit trap.
We've talked about all these amazing new deductions, right? But claiming them puts you right in the crosshairs. So what actually triggers an IRS audit for a self-employed taxpayer? Well, here's the harsh reality. Because your income and deductions are self-reported on a Schedule C, your return naturally draws way more automated scrutiny than a standard W-2 employee's return. The system is literally hardwired to hunt for anomalies. And here is exactly what their algorithm is sniffing out: 1099 income mismatches, mixing up your personal and business expenses, slapping vague labels like misadmin into the other deductions category, but the absolute biggest one: defying industry norms. According to our sources, if a personal trainer suddenly tries to claim $10,000 in research and development, the system is going to flag that instantly. Your expenses actually have to make sense for the work you do.
Which leads us right into a sneaky new pitfall for 2026, the 1099 NEC threshold trap. The reporting threshold for clients to issue this form just jumped from $600 way up to $2,000. But listen very carefully here. Just because you didn't get a form for a $1,500 payment does not mean it's tax-free. You still have to report every single dollar, whether it's cash or a small digital transfer. Leaving income off your return just because it didn't come with a 1099 is a one-way ticket to an income mismatch audit.
And look, if you're highly successful, you have a natural target on your back. Audit rates climb really sharply for anyone earning over $500,000. And when you combine a super high income with those massive $2.56 million Section 179 deductions we covered earlier, you are practically guaranteeing an automated review, which means your documentation better be flawless. That brings us to our final section, Part 5, Bulletproof Record Keeping. If you want to claim all these deductions without losing sleep, here is your 3-step survival guide. Step 1, rigidly separate your business and personal finances. Dedicated accounts are 100% non-negotiable. Step 2, track everything digitally. Seriously, shoeboxes full of fading paper receipts are completely useless today. Get on the cloud apps. And step 3, run a pre-filing audit checklist. You want to catch any weird mismatches yourself before the IRS algorithm does. There's a great quote from our sources that really serves as the golden rule of tax compliance. It goes, if you can't prove it, you can't deduct it. It really is that simple. You could have legitimately driven 10,000 miles for your business, but without a clear, dated, digital mileage log, you lose the deduction, and you end up owing the taxes. So I want to leave you with a really vital question to think about right now. Is your current record keeping strong enough to defend your 2026 deductions from a highly advanced IRS algorithm? Don't wait until tax season to figure that out. Take action today, audit-proof your business, and confidently keep the money you worked so hard to earn. Thanks so much for joining me on this explainer, and I'll catch you next time.